Okay, a very warm welcome to everybody as we start today's webinar. Hope that everybody is doing well and keeping safe during the current health crisis. As always, let me just do a quick audio and visual check, making sure that you guys can hear my voice and see my screen. Okay, awesome. Thank you, Stuart. Thank you, Armand. Thank you, James. Sergey, thank you, Alan. Thank you, Jennifer, Ashley, Richard, Ryan. Thank you so much, guys. Really appreciate that. Okay, awesome. So after a successful test run of our software last week, we have officially sent out some invitations to some of our community members today to join our webinar today from a YouTube live stream. So for those of you that might be joining us for this special session from YouTube, very welcome to you guys as well. If any of you joining us via YouTube have any questions, please feel free to pop them into the YouTube chat. We will, of course, go through all of our ForexSource subscriber questions first and making sure that all of their questions are taken care of. And then we'll take a couple of questions from YouTube as well. So feel free to pop them in as we go. So then jumping into today's session, let's just do a very quick rundown of today's dominant drivers in the market. So for the past 2 days, we have seen the overall risk zone being whipped around from positive to negative and then from negative to positive due to a couple of factors, both positive and negative in the markets. The negative ones is the growing fears and concerns of a possible second wave of coronavirus infections as economies are starting to reopen. And then we also have the resurfacing, of course, of the US and China trade tensions. Now, the positive ones is obviously the actual reopening of the economies and some positive signs and signals with regards to certain coronavirus treatments. Now, another factor that is creating a lot of whipsaw in the markets right now is some of the mixed signals that we've been getting from global macro markets. Now, I know we mentioned this on Monday as well, but I think it is important to stress that same point again here, which is a possible reason why we're seeing this up and down movements in terms of risk flows. And it is something that is getting a lot of attention in the broader analyst space now as well. At the same time, it's not really being taken seriously enough, in my opinion. So let's just quickly jump to our top trading opportunity report for this week. It is something that we highlighted in there as well. And that's basically the divergence that we're seeing right now across global macro markets, with equity markets pricing in that the worst is behind us and looking forward to a possible V-shaped recovery. And at the same time, we have things like equity markets, we have fixed income, as well as the currency space, not really being so eager to price all of that in at this stage. Now, this is taking a little bit longer. So let's just go to this chart over here. Now, if we just quickly take a look at this chart, we can see that this chart basically overlays the S&P 500 performance and overlaid with the Bloomberg Commodity Index in red and the US 10-year yields in blue. Now, we can see that there is a lot of uncertainty right now, with only the equity markets really pricing in all of that positivity and seeing lots of downside still for other markets like commodities, like fixed income. So it's really only the equity markets right now that's pricing in all of that positivity. Now, we have seen many investors on the sidelines with some articles reporting a record holding of cash right now during this uncertain times, waiting for the dust to settle before recommitting to any type of assets. And another important point that we can share is the actual positioning right now, which is also important. Not only are we seeing equities up across the board, we're seeing that divergence between global macro markets. But if we quickly take a look at yesterday's daily risk event outlook report, we highlighted the fact that even just from a positioning point of view, the markets are very much in doubt right now about the upside that we're seeing in equities. We can see a record low position going back all the way to 2015 in terms of the S&P 500. So that is very interesting. The markets aren't really buying in to that positive moves right now, which is something that is interesting that we need to pay attention to. Now, even though the equity rally obviously doesn't make sense from, let's say, an economic outlook or an economic point of view, it was very interesting for me to look at positioning because even though we have seen equity markets continue that rise to the upside, if we just go to the daily time frame, it does mean that the broader market still expects further downside, which is very interesting. And that might be one of the reasons actually why we are continuing to see that move to the upside. So the real pain trade right now in global macro markets is definitely this upside move we're seeing, because we can see majority of the market is still priced to the downside. And due to positioning, we might have some room left still to squeeze to the upside. So that is something we need to pay attention to. But the more important thing to keep in mind is that divergence we're seeing across asset classes. This is very important. The real question now, of course, is which asset class is right. Will we see equity markets follow lower in line with commodities and fixed income? Or will we eventually see the other markets start to catch up with the S&P 500 and the other equity indexes that has moved higher? So a couple of things that we need to consider right now. Now, looking at today's session, we did start out with a slightly more negative risk tone across the board. As we mentioned, some of the negative comments basically came in the form of yesterday we had US health officials coming out saying that the possibility of a second wave of infection is a real threat right now. It is something that's getting more attention. We also had very dim and bleak outlooks from some of the regional Fed members coming out across the board. And then, of course, we had that further ratcheting up of the US and China tensions, with some Republican senators actually opting or proposing possible sanctions on China, or giving President Trump the ability to put sanctions on China if they don't come clean, so to speak, with regards to the handling of the coronavirus. So looking at how the markets have been reacting with that news, obviously in yesterday's session, late in yesterday's New York trading session, we had that big drop to the downside across the board in terms of equity futures. We can see these moves to the downside. Now we have continued higher in today's session. I mean, in relation to yesterday's move, it's nothing massive, but we have seen a continued move to the upside. And it does look like the equity markets are trading slightly more on the positive side for today. Also looking at commodities are moving rather more sideways, no clear bias in terms of actual risk flows right now. Looking at the yield space, after the moves to the downside yesterday, we have seen it move more sideways. So it is looking like a slightly more mixed risk tone right now in the markets, and which is probably why we haven't really seen any type of follow through on transmission effect from the more classic risk sensitive currencies in today's session. So looking at the equity markets, it started out negative, but we haven't seen any transmission effect into the Aussie and the CAD. They are actually doing well in today's session. We know why the Kiwi is moving to the downside. We'll discuss that just now. And we're not really seeing any type of major risk flows for the Swiss franc and the Japanese yen. So a couple of things just to keep in mind. Now, looking at the Kiwi dollar, it is obviously leading the pack to the downside. That is in follow-up with the RBNZ's policy meeting that we had. Now, they kept rates unchanged as was expected. They also doubled their Kiwi program, which was also expected by the markets, but they did strike a lot more dovish tone by saying that they are at this stage aiming for the least regrets policy response. And they basically want to start, New Zealand banks need to start preparing themselves for positive negative interest rates before the end of this year, as the option of negative rates is definitely still on the table. Now, those dovish comments has definitely weighed on the Kiwi dollar in today's session. It is currently leading the back to the downside, and we do expect further weakness or that dovish tone to weigh on the currency for the rest of today's session. Now, some of the currencies that we are looking to pair against the Kiwi, the first one is the Australian dollar. I think this is an interesting one, not only from a short-term point of view, but also from the more medium-term point of view in terms of a swing trading opportunity or medium-term trading opportunity. What we're looking at here is a possible policy divergence between the RBA as well as the RBNZ. So on the one end, we've heard the RBNZ coming out today, possibly going to negative interest rates and basically doubling their QE program. On the other side of the coin, we have the RBA that's basically started to taper down their bond purchases, and they're actually looking to keep rates unchanged. So there is an attractive opportunity here from a central bank policy divergence point of view for looking for more upside in the Aussie versus the Kiwi dollar. Looking at some possible technicals, we do have this overall area coming in at that 107 psychological level, also confluenced there with the 50% fib level, as well as these highs going back to the 7th of May, which should now act as support for the pair. So anything down in that level does look attractive from a medium-term if we get there today, even a short-term trading point of view. So definitely something to watch. A risk factor here, just to keep in mind, obviously, is the ongoing US and China trade tensions. The Aussie is more sensitive to issues with China. So if we do see that breaking out and it's a massive escalation, obviously that'll weigh a lot more on the Aussie compared to the Kiwi. And that can be a risk factor that we need to keep a very close eye on for this pair, but definitely expecting more upside for this move. And then the other one that we can consider is the Kiwi yen. Now, the Kiwi yen largely going to be dependent on the overall risk tone that we see in the markets. If we do see equity markets turn back lower, remember the reasons for the markets trading negative yesterday, none of those reasons have gone away, right? The economic outlook is still negative. The possibility of a second wave of virus infections is still there. And of course, we do still have the US and China trade tension. So unless anything changes, the bias is arguably still tilted to the downside for the overall risk tone. So that is why we could look for a possible trade on the Kiwi yen. If we see a further escalation in the risk tone turning negative, we can look for some potential downside. We can either wait for a pullback back up to that 65 psychological level to re-engage at the downside, or you can wait for this overall level at that 64.50 to break, wait for a possible pullback, and then re-engage the pair to the downside, targeting this most recent fair value areas. Looking at some of the other currencies, some interesting movers today was the pound. Surprisingly, we did see some upside after the UK GDP data for Q1 came out. Nothing for the markets really to get excited about for today, to be honest. Yes, some of the data came in slightly better than expected, but we know the main focus will be on Q2 data. So this was just a little bit of a taster to see exactly how bad the economy contracted in those first couple of weeks of lockdown. So nothing really to get too excited about for the markets, especially while we have all the other negative catalysts in play for the pound right now. Today, we had an announcement. If we go to the terminal, we had that announcement coming through saying that the UK's budget is on course. They're on course for a budget deficit of 337 billion pounds compared to just 55 billion forecasted in March. So, I mean, these are scary numbers. So it is a little bit interesting for me to see the markets getting ahead of themselves with regards to that move to the upside in the pound, but it might also be just driven by some general weakness in the US dollar. Now, that takes us nicely to the dollar. We've got lots and lots of questions in the Q&A section of the terminal with regards to the dollar. We've had a couple of questions as well. So I thought I'll just spend a little bit of time on this today, just explaining exactly the type of moves we're seeing. Now, of course, yesterday we saw downside in the dollar on the back of the more positive risk tone we had with equity markets, yields, commodities all moving to the upside. And the thing that basically gave us a little bit of a jump to the upside again was when we had several federal speakers coming out yesterday pushing back against the idea of negative interest rates. Now, interestingly enough, last week we had some money markets coming out actually pricing in negative interest rates for the US for the very first time. Now, this was a significant shift, and the Fed comments was a very important point for us to watch, which is why we did highlight it in yesterday's trading opportunities report as well, watching out what type of comments they have about negative rates. Now, in today's session, we also do have Fed Chair Powell coming out at 2 p.m. UK time. A couple of the things that the market will be waiting for, listening to from Fed Chair Powell will also be his comments with regards to negative interest rates. Not expecting any significant changes from him compared to the comments we had yesterday already and on Monday from Fed speakers, but it is something we need to watch. Also, his comments about a possible yield curve control being set in motion for the US is something we can watch. And also just his general forward guidance. Now, apart from the pushback we had yesterday in terms of the negative interest rates, we obviously also had very negative comments from Fed members, basically just putting the current economic situation in a little bit more perspective, especially for some of those market participants still hoping for a type of V-shaped recovery, which is just, in my mind, overly way too much optimistic at this stage. Now, all of that saw additional support for the US dollar. Now, we got a lot of questions on why the dollar increased on the back of the negative economic outlook. Now, it's important to remember that the current, in the current market environment, right, the worst that the data gets and the comments get, the better and more supportive it will be for the dollar. Because the dollar is in high demand during times of global economic crisis. Now, the reason why the dollar acts as a safe haven during times like this is basically due to its reserve currency status. So it means that there's a lot of usage for the dollar outside the US. Lots and lots of countries use dollars. So when global trade starts to suddenly slow down like we've seen recently, it means that there's going to be a lot less dollars flowing internationally between countries, between businesses, which obviously creates a little bit of a supply and demand issue. And it's not only a problem from just the regular functioning point of view, but also keep in mind that almost 40% of the world's debt is dollar denominated. So those countries, companies, governments, etc., they all need dollars to service those debts, which obviously adds to that demand problem. So whenever we have times like this, whenever trade starts to slow, and whenever we see recessionary fears, there is normally that resurgence of dollar safe haven bids, and not only because the dollar the US economy is considered the safest economy in the world. Not only because of that, but because of that reserve currency status, there's always going to be demand for the dollar for those particular reasons. So right now, in today's session, given the more, let's call it tepid risk flows that we're seeing, we would expect the dollar to remain fairly supported with the negative catalysts that are still in play. But obviously, we have seen that change in yesterday's session with those small bouts of risk flow. So there's a couple of things we just need to keep in mind. So looking at today's session, we are looking for possible upside in the Aussie Kiwi. We've explained why. Looking for possible downside in the Kiwi Yen, and we have explained why. So looking at some of the upcoming events, as we said, we're looking for Fed Jerome Powell's speech coming up at 2 p.m. UK time. Now, in terms of yield curve, in terms of negative rates, as we said, not expecting any different comments from his side as opposed to what we already had yesterday and Monday. Looking at possible yield curve control, it's not. I'm not thinking yield curve control will be a major mover for the dollar. Right now, monetary policy isn't the biggest focus for the dollar. It is actually the dollar demand for the reasons we've mentioned. So having something like yield curve control will possibly have an impact in the fixed income space a lot more compared to something like the currency space. Obviously, it is something that they might be considering. We have other banks already doing it, like the BOJ, like the RBA. So we might see that coming into play. I think the bigger focus for that speech will be the overall forward guidance, especially since we got that bleak economic outlook from some of the other regional Fed members yesterday. It'll be interesting to see how Fed Chair Powell sees the overall economy, where we're going, and of course, what type of other tools they might have in store for us. Also in today's session, apart from that, very, very light, we do have crude oil inventories. Now, if we just quickly go to today's daily risk event outlook report, let me just quickly open that up. Interestingly, you guys remember in May, we obviously had the huge spike to the downside in oil markets. Now, the reason for that spike to the upside was because we had major issues in terms of or lesser capacity in terms of storage space. So all the storage hubs around the world were starting to fill up. And obviously we saw that big jump to the upside, that big draw, and that saw lots of pressure coming into the oil markets. And we had lots of negative pricing in terms of the May contract. We have seen some upside in terms of oil prices recently. If we just quickly take a look at something like WTI on a little bit of a wider time frame, we have seen some alleviation in terms of the inventories. Obviously, we can see that chart. We have seen a continued move to the downside in terms of crude oil inventories. Now, that is seen as a positive. We also had OPEC coming out, or the Saudi Aramco, with a directive to increase production cuts to 1 million barrels per day. That was a positive. Alongside that, we've also had US shale and production cuts coming in, furthermore, closing down of rigs. So all of that is basically putting the supply and demand balance slightly more into perspective. It's not balanced yet, but the expectations, the forward-looking expectations, has certainly been positive for the oil market. So in today's session, what we're looking for is, if we do get a much bigger than expected build in crude stocks, we would expect that to weigh on oil prices. As it weighs on oil prices, we would expect that to also weigh on the oil-linked currencies like the CAD, the Norwegian krona, the Russian ruble, the Mexican peso. And if we do get a major move to the downside, maybe even a draw, that can see some further upside in oil prices and obviously support the oil-linked currencies as well. So definitely something we need to watch. Apart from that, nothing really major in today's session. And then we have the Aussie jobs numbers. So Aussie jobs numbers, for me, is I think the market has already discounted a lot of the negative impacts, but there's a couple of interesting things for me about the Aussie dollar. Obviously, looking at it from a performance point of view, if we just go to the daily for the majors, we have seen the Aussie dollar outperform recently compared to some of the other major currency pairs. Obviously, most of them following the dollar's more range-bound moves recently, but we have seen continued upside and an outperformance from the Aussie dollar. Now, even though we know economic data has taken a backseat due to the global pandemic, etc., I think the jobs report will be more significant this week for two reasons. Firstly, Australia, remember, is going through their very first recession in almost 30 years, 3 decades. So the scale and the pace of the slowdown is something that they're definitely not used to. And even though they've done quite a lot from a stimulus point of view, the shock to the economy will be unprecedented, and there is some follow through still to be expected. Now, we know that the Aussie dollar has outperformed in April as well as May, mainly due to the support from the rally we saw in global equities, but also some recent data points that's been surprisingly better than expected. So we had retail sales numbers that saw a huge jump alongside also trade balance data. And then, of course, the previous March jobs report. Now, it's not all unicorns and marshmallows, so to speak, with regards to those data points. Yes, retail sales were much better than expected, but they were lifted due to all of the manic panic buying coming in from stockpiling before the lockdown, turning to something like a trade balance. Yes, iron ore and gold saw massive spikes to the upside, but it was mostly driven due to China starting to reopen the economy and basically getting rid of some of that that slack in terms of getting new stock in. So turning to the March data, yes, it was also better than expected. If we quickly open up the terminal again, we can see employment came in at 5.9K. Now, obviously, yes, better than expected, but it's important to remember that the March data completely missed the lockdown job losses. So it only incorporated that first 2 weeks in March. So that will definitely not be the case for the April data. We can see consensus is already pricing in a contraction of 575,000, which is the biggest number in Australian history. And it is a big deal, especially since they're going into that first recession in 30 years. Obviously, a lot of negativity has been priced in. For me, I think the most surprising part is seeing that some analysts actually expect a build of 450 or a jump of 450,000K. This just doesn't make sense at all. So not exactly sure whether that was a fat finger error or what happened there. But the risk is definitely skewed to the downside. And I think once that data comes in and the reality starts to sink in for the markets, we might see some potential downside for the Aussie dollar. So it is something we need to keep in mind, especially since we're looking for some potential upside for the Aussie versus the Kiwi. I think there's a couple of things we need to pay attention to there in tomorrow's session. So guys, that is everything from my side, what we're looking at, what I think is interesting, especially with the events coming up. Now will be a perfect time to quickly pop in any type of questions that you guys have into the Q&A box for me. It's always just a lot more easier to keep track of it in there as opposed to the chat feature. So let me just quickly run through these. Okay, the first question here from Ryan. Could today be a win-win for gold? Powell shoots down the possibility of negative rates causing gold to drop, which would present a buying opportunity. And if Powell says there is a possibility of negative rates, could we finally see this breakout to the upside that was talked about in a video earlier or yesterday? So, I mean, looking at gold, you're right. Gold is definitely the main mover for gold, right, is interest rates. So especially real interest rates. And for those of you that wants more information on how real interest rates affect gold, obviously there's a lot to be said, so I'm not going to go into the whole breakdown now, but we do have a video for that in the terminal. You guys can just scroll back and look or search for that. So gold really likes lower interest rates, especially when real yields or real interest rates go negative. So obviously how you get to real and negative interest rates is when your interest rate is so low and inflation is higher than that, you obviously get a negative yield or a negative real interest rate. And that is something that gold absolutely loves. Now, apart from that, gold also likes the expectation of lower interest rates. So It'll be an interesting thing for us to see today. Like you said, I think if we do get an announcement of any type of illusion that there might be negative interest rates coming in, at some stage, obviously that'll be a great opportunity for us to look for gold. For me, it might be the thing. It might be the breakout that we're waiting for. I mean, obviously, there's a lot of analysts that's looking at that particular structure right now, with regards to support and resistance, looking at a potential break either to the up or to the downside. I mean, for me, the one thing that I'm just weary of is just positioning right now. So there's a lot of positioning that is already bullish on gold. If we just go to the higher time frames, you guys that's been following my webinars for a while will know that I normally like to buy things on sale as opposed to buying a premium or paying a premium price for it. So for me, I would like to see a lower price. Definitely would like to get involved at a lower price. If we do see that breakout, obviously it can go higher. That might be the possible catalyst to see it go higher. At this stage, I'm a little bit wary of where we are in terms of positioning right now, where we are at the levels. But I'm definitely still have a bullish bias on gold right now, Ryan. Whether it happens today, I mean, we'll need to wait and see. From a more medium-term point of view, I would definitely like to see a little bit of a better price coming into the market. But we'll need to wait and see whether we get that opportunity or not. Okay, awesome, Shariel. Always a pleasure. So Shariel's just saying thanks for the intermarket monitor video that we did in the terminal. For those of you that didn't catch that, we just quickly went through on how to build that. So for that, you can just go to the terminal, open up the video commentary section, and you should see the video there, how to build an intermarket monitor right there. Okay, so let me just quickly see what other questions we have. We have a question here from Asanka with a link from MyFXBook. This link shows that open positions of currency pairs of retail traders. Can we use these details for our trading? This is something called retail sentiment. Can you give some ideas on this if you can? Yeah, so I mean, there's actually lots of websites out there that'll give you a contrarian view of the market. So the general thinking out there is that you get smart money and dumb money, right? So smart money is normally going to be your institutional investors and traders, and then the dumb money would be the general retail base that's always late to the party, so to speak, with regards to a trade. So you get a couple of contrarian indicators out there that basically tells you, okay, 90% of the retail community is short on this currency pair, so this is the time that you want to be buying it. It is valuable, I think, from a positioning point of view to look at that info. But I mean, personally for me, I prefer looking at it from a more fundamental way, a sentiment driver point of view. So I won't have a problem buying something if the entire retail community is buying it, if I think there is a valid reason to hold on to that particular trade, and vice versa. So I think there is value in it. But as I said, it's not really something that I include in my daily analysis, so to speak, Asanka. So I mean, it is something valuable to know. It's good to look at that to see where in the pile you're sitting, whether you're sitting with the retail community or whether you're sitting with the institutional guys. But for me, it's not really something that I'll look at on a daily basis, really. We have a question from Sibu. There's also a divergence between global equity markets and US equity markets. US equity markets are the home of manufacturers of FOMO. That's well said there, Sibu. One thing those speculators will learn is that the equity market is not the economy. Yeah, definitely. So knowing that, how does one trade that effectively? Might have to leave early, so I might have to hear your response later. Okay, awesome. I think that's a great question, Sibu. I mean, personally for me, the way that I'm trading this particular environment, especially as it relates back to equities and how that relates back to the FX market, is keeping everything on a very, very tight leash right now. So with all of that uncertainty going on, my base case scenario is definitely for further downside in the equity markets. Based on all the information that we have, I do think that equity markets have gotten a little bit ahead of themselves, especially US equity markets, when we compare global macro across the board, like we said, comparing currencies, commodities, fixed income. Everybody's tilted to the downside, while equities are just continuing to the upside. So I think, obviously, we know there's a lot of euphoria going on right now with the unlimited Fed QE program. We've got all of the synthetic propping up of asset prices going on. So there's a lot of short-term things that's causing the market to be more positive. As we mentioned, positioning is also another important thing. Remember, the market loves to squeeze, right? So if everybody is priced to the downside for the S&P, we might see the S&P either move sideways or continue higher, unless some of those short positions starts to exit the market. So that is an important point to keep in mind, is the overall positioning. I wouldn't want to be trading any type of risk sentiment type of trades in the medium term right now. For me, I'm keeping everything on a very tight leash. I know the overall bias for me personally is tilted to the downside, so I am a lot less inclined to take trades with positive risk sentiment, if that makes sense. For me at this stage, I'm looking at any massive rallies as basically selling opportunities for high risk assets, whether that is equities, whether that is the high beta currencies. For me, I think there's more downside than upside. So I'm keeping it on a very tight leash, trading those short-term clear sentiment drivers. So for me, last night, just a no-brainer trade, because I have that overall downside bias for equities, was the news that we got about the Republicans, the Senate, U.S. Republican senators opting for that proposal to give President Trump the ability to place sanctions on China, and then also the U.S. officials that said that, listen, there's a real threat of a second resurgence. For me, that was like a no-brainer trade to sell the S&P 500 futures market. And I also took a sell trade on the Aussie yen and the Aussie US dollar. Also think the Aussie CAD as well. So just rode that out for a couple of pips to the downside and basically got out. So for me, that's really the best way to take advantage of that bias. We know the market is well, our opinion, at least at this stage, is that the market is wrong-footed right now in terms of the equity markets. So there is opportunities in the short term, but for me, I'll be very skeptical to go anything longer than short-term trades right now, just with everything that's going on. Obviously, when it comes to something like gold, if we can see a big move to the downside, that's definitely something that I'll probably load up on a bit, taking advantage of the overall outlook. Whether we will get lower prices, of course, is just don't know. I hope we do. Otherwise, it might need to compromise on looking for lower prices. But that's really the only type of thing that I'll look to trade from a more medium-term point of view right now. Okay, question from Jennifer. What does the yield curve control mean exactly? Okay, so what the yield curve control basically means is the central bank will basically choose. It's normally more longer dated treasuries or securities. So it'll be the back end of the curve, so maybe the 10-year or the 20-year. We have seen RBA actually opt for a 3-year one, which was interesting. It's a little bit more to the shorter side of the curve. So what they basically do is they will take a specific duration security. So let's say it's the 3-year in the RBA's example. They will basically set a target to say that, okay, we want the 3-year yield to sit at this specific level. So whatever that yield target is, and they would basically lower and increase their bond purchases to try and stay as close to that target as they need to get. So if they see it moving below or moving above, they will adjust their bond buying purchases or QE to basically bring yields in line with that specific with that specific target. Now, the main reason why they want to do that is basically to, if you basically at 0% already or close to zero in terms of interest rates, and you don't want to go to negative interest rates like the US and like the RBA or like the FOMC rather, or Fed, what you can opt for is something like yield curve control. So you're trying to keep let's call it the expectations for rates to not go lower. You're trying to keep that from causing yields to either shoot up too high, and the expectation of possible lower rates, you're trying to keep that from pushing yields too low as well. So you're trying to, at the same, you're trying to protect your fixed income market, but at the same time, you're trying to keep a lid on any potential moves to the upside in terms of yields. So it's basically just them trying to control and protect the bond market from any massive spikes in terms of yields, whether that is to the down or to the upside. Mark is asking, what time can we expect the oil inventory data? Let's quickly see what we have priced here for Zenith. It looks like, okay, this is my local time. So that'll be 3:30 UK time, according to Zenith here, Mark. We have a question from Nick. How's it, Nick? Out of interest, will you be up trading the Aussie employment numbers as they come out? Nick, you know what? I used to get up for each and every single Australian and New Zealand big announcement, every single GDP, every single employment, every single event, and something that I lost a lot of sleep due to that. And what I've been doing for the last, let's call it, I don't know, maybe 16 months or so, I've tried to rather opt for better rested trading days compared to trying to catch that move to the downside. Obviously, if during the Asia Pac session, because there's thinner liquidity, if you've got a clear trading opportunity like we had with the RBNZ this morning, you can often catch a great move. So you can basically trade it. You can jump in and jump out in half an hour, an hour's time, bank a couple of 100 pips and go to bed, and you've already made your target. That's great. But for me, it's just not worth it anymore. I'll trade whatever happens the day after or during the European trading session. Sometimes if we do have that important event, I might get to my desk a little bit earlier to see if I can catch a possible move before the European session starts. But these days, I rarely get up at that time to catch the news. It's you can catch great trades, but for me, it's just not worth the missing the sleep at this stage, especially if you've got two little ones in the house like me. You need to catch up on sleep whenever you can. So I'm definitely not going to be there live. Okay, a quick analysis of the pound yen. Let's quickly have a pound yen. I actually haven't looked at the pound yen in today's session. So looking at the pound yen from, let's say from a short and a medium term perspective, right? The bias for me in both the short and the medium term is tilted to the downside for the pound right now. In the medium term, we have the Brexit negotiations, which isn't really going anywhere. We had that negative comments yesterday as well, with the UK officials saying that they're going to tell the EU that they should forget about adding fisheries to any type of free trade agreement. Now, fisheries is a very, very contentious point right now. So there's a lot of negativity in the medium term. In the short term, just the overall economic outlook for the UK. The UK economy is really they're strapped right now in terms of negativity. The economy is really suffering, really hurting right now. So for me, the bias is definitely tilted to the downside. Whether I would trade it today will probably be dependent on the overall risk tone. So I wouldn't want to. So for me, the bias is to the downside. We are getting to very important levels to the downside right now. But I wouldn't want to trade this just off the cuff. I would probably wait for a short-term risk negative catalyst that maybe pushes the equity markets down again. That should be more supportive for the Japanese yen, and that can create an opportunity to short the pound yen. Looking at it from a technical point of view, I think this fair value area coming in at that 131 psychological level is a good one to watch for possible profit targets. And if we do get up here, this also looks like an interesting zone from a resistance point of view, coming in at that 132 psychological level, well within the range, the recent range. So If we do get the pair edging up and we see risk sentiment change to the negative side, I think that can be an attractive opportunity to look for. Very, very attractive level, this one, from a technical point of view, coming in at that 132 level. But wouldn't want to get involved just at this right now, at least. I would want the market to have a reason to basically buy the yen against the pound. DGB, can we use the Fed planned treasury or TIPS purchases amounts to our trades when the Fed buys those treasury or TIPS? Not really. There should be those day in and day out operations isn't really gonna have too much of an effect in terms of the overall currency space. Obviously, the broader picture in terms of liquidity is the important thing to keep in mind. But with the scale of the purchases, we've seen the Fed from mid-March already at, what is it, up to 1.6 trillion already. So those day-to-day operations isn't really something that I pay too much attention to on a daily basis. Okay, we have a follow-up question here from Ryan, a follow-up to Jennifer's question about the yield curve control. Why do central banks generally buy longer-term bonds as opposed to shorter-term bonds when attempting to control the yield curve? That is an excellent question, Ryan. So the whole idea, so your shorter end of the curve, right? So you're talking about your monthly treasuries or securities rather, up to anything, let's call it the 5-year. That's normally your shorter end of the curve, and that is normally a lot more affected by your short-term interest rate expectations. So whether the central bank will cut next week or whether they will cut next month, etc. So that's normally a good way to control the curve from a shorter end point of view. Is just the forward guidance with regards to shorter-term interest rates. Now, when you are at zero or close to zero, and you're not willing to go to negative rates, there's only one way that you can go from zero, right? And that is up. And because that expectation is normally priced into the market, you normally see the longer dated or the bottom end of the curve or the back end of the curve. You can sometimes see some volatility just out of technicality. You can see interest rates on the wider end of the curve or the back end of the curve start to move up. And it's not because they're expecting high interest rates. It's just because when you're at zero, you can't go lower than zero, right? So unless you are willing to go to negative interest rates, which is why we've seen a further breakdown in terms of New Zealand government yields to the downside. Now, why they opt for the longer dated bonds is because they want to keep the longer term interest rate expectations as low as possible. So that is the first reason why you would introduce something like QE in the first place. So your interest rate is super low and you try to get the markets to assume lower interest rate expectations for the next couple of years at least. Then you would bring in something like QE because you can't go lower than zero. You want to try and stem that expectations for higher rates. That is what QE does. Now, when you're at zero and you're doing QE and you can still see expectations for rising rates, then the only thing that you can try and do is try to opt for longer dated or wider dated bonds to try and control that type of yield expectations. So try and keeping your longer dated ones in check. Your shorter term ones won't really be affected because your rates is already zero, and your forward guidance will cause the markets to basically price in rates not going anywhere within the least 2 to 3 years. And then the idea of keeping those that yield curve controlled at the longer end is just to try and stem that expectations for the wider end of the curve. So it has to do with the longer term interest rate expectations. Okay, no problem there. There should be. Okay, we've got a quick question here from Shabeen. How do we use the ADR in our analysis? Does it show the average range for that past day or X number of days? Yeah, exactly. So it's basically just showing you the volatility, the expected volatility range based on the last 10 days. So we've basically set it up to 10 days. Let me just try and open this up. Come on. There we go. So you can see that our input is basically 10 days. So we want to basically see the last 2 weeks worth of price action volatility. And that is what the ADR shows us. And we actually did a video on exactly how we use the ADR, Shabin, in the terminal. If you go to the video commentary section in the search bar, just pop in the word or the term ADR. And I think we did 2 or 3 recently that you can just view. That'll show you exactly how we use it on a day-to-day basis. Okay, awesome, mate. No problem at all. Always a pleasure there, Ryan. Okay, we have a question here from Sergey. Every day you see BOE Gilts repurchases ratio on the terminal. Could you explain how it's affecting the pound? So it's almost the same question about from Deshaby with regards to the Fed's planned treasury tips purchases. Those type of daily operations isn't really going to be something that affects the currency. Obviously, the expectations for QE before it happens, and then as it happens, when it will be tapered. Those are the real type of things we want to be watching for in terms of the effect that can have on the currency. But from a day-to-day point of view, it's not really something that we pay too much attention to or have expectations of big moves from that there, Sergey. Okay, guys, it looks like I've gone through the Q&A box. So let me just quickly pop over to the chat and see if there's any questions that popped in there. Oh, wait, I see we got one more here from the Q&A. Mark is asking, how do you navigate between higher and lower timeframes? You're currently using moving averages, which change depending on the time frame, which can make it difficult to maintain trade ideas. Looking to develop better entry methods, but aware that the markets aren't really behaving as we might hope. So, I mean, when it comes to time frames, we try and keep things, at least for me, from a personal point of view, I try and keep things as simple, really, as I can. So, you know, if I'm trading on the M30, obviously, we've said it many times. There's no perfect time frame to use. So if you're taking a swing trade, for example, you're probably going to want to trade from the H1 or the H4, maybe even the daily. And if you're going to be more inclined to taking day trades, you're probably going to want to look at the M30, maybe even the 15 minute. I think the 5 minute might be a little bit too tight. But generally speaking, we like to use the 15 minute or the 30 minutes. Now, it's not because there's like any type of secret sauce with that time frame. It's just because from a 30-minute point of view, I get the best of both worlds for me. So I get to see the last couple of days price action, which I want to see, and I obviously get to see some of the more nuanced moves from the shorter moves we see in the market as well. So I prefer the M30 for day trades, and then obviously the H4, the daily, for higher time frames. Now, when it comes to stuff like moving averages, of course, there's going to be that disconnect, because you might have, you know, something above or below a specific moving average based on the time frame you're trading. I mean, personally, I used to use stuff like moving averages. It's not really something that I use anymore, really. Not because I don't think it's useful. It's just because I get more value from just looking at the raw levels in the market, if that makes sense. So looking at basic support and resistance, looking at basic retracement levels and psychological levels, I find a lot more value and a lot less stress that way, because you know, flipping through. So now you're checking the 5 minute. What is the moving average? What is the 20 EMA doing on the 5 minute? What's it doing on the 15? Okay, but it's down here, it's up here, it's moving sideways here. I think a lot of that confusion just used to keep me out of a lot of good trades. Again, I'm not saying don't use them. They are valuable. Sometimes I would pop up a 21 day or a 21 moving average EMA if I wanted to look for a possible confluence area in terms of a retracement zone. But it's not really something that I'll break my head about. The advice that I would give you is to stick to one time frame with it. So don't overcomplicate it from a trading point of view. Keep it as simple as you can. So if you're trading a day trade, stick it on the M30 and just leave it there. Trade it according to that specific time frame, obviously according to the levels that you set out. If you're trading a swing trade, pop it onto the H4 and just use it in that time frame. I think there's a lot more value in looking at the way the sentiment is moving the market, as opposed to how the pair is trading on different time frames versus the moving averages. Obviously, the most valuable part from a moving averages is expecting mean reversion. You're obviously expecting a mean reversion to that average, which is why it's a helpful tool. But don't let it confuse you, or frustrate your technical analysis, so to speak. Make sure that you're trading in the right direction based on the sentiment, and try and keep it as simple as you can in terms of the way you use it in different time frames. glad I could be of assistance with that chuckle there, Mark. Okay, so let me quickly pop over to the chat. We've got a question here from Armand saying that the audio is dropping intermittently. Is there any other challenges with the audio, guys? Okay, wait. Armand saying it's okay now. Jennifer, I think the invite was actually sent to the list, to the email list. I don't think we did anything specific for YouTube. I think it was mainly just on the list. But if you're a subscriber and you've got the bell notification up, you should get a little bit of a preview saying, okay, we're live or something like that. But it wasn't, I think, sent specifically to YouTube now. Okay, Augustine asking about the time frames. Okay, we did touch on that. Awesome, James. Always a big pleasure. Yanku saying that the Aussie dollar is annoying right now. Yeah, yeah. You know what? It's I think it's caught a lot of traders off guard, especially with the outperformance we've seen recently. But I've the frustration with it, I think, is the exact same frustration that a lot of traders are feeling in terms of the equity markets right now. If we have a look at that, the positioning, the pain trade right now is definitely to the downside for risk assets, equities, especially Aussie. So I do feel you on that. It's moving very indecisive, and I think it's partly due to that uncertainty in the market right now with all the mixed signals we're getting across global macro. I think that is part of the reason. I mean, from a medium term point of view, yeah, until I'm convinced that this improves the outlook for the economy, I'm still taking a more bearish bias on the Aussie dollar from a more medium term point of view. Does that mean that I'll just sell it now and leave it? Definitely not. As I said, I don't want to have any type of medium trades running right now just because of all of the uncertainty. Just a lot of chop recently. But any type of clear, fresh catalyst is definitely something that I'll jump into. So yesterday was, as we said, a great example. We had that rally, just a monster rally in the Aussie. And when we had the news yesterday coming out from the health officials and the US, the possible sanctions, for me, I just took a short entry, just wrote it out a couple of pips alongside the S&P as well, and banked it in and out, an hour or so, made some money, happy. I think that for me is the best way right now to go about it. Just with all of the uncertainty, it can be a little bit tricky to trade the risk sensitive currencies like right now. Okay, I think that is everything on the chat. Let me just take a quick another look at the Q&A box before we move over to some of the YouTube questions. Jen, what time is the webinar? It's actually this one that we're in now. So it was the same at the same time, the 11:30 UK time. Would the current levels for the pound US dollar be considered for a swing trade down to the 120? Let's quickly take a look at the pound. You know what, just from a purely technical point of view, Rich, I'd probably feel a little bit more comfortable for a slightly higher price, maybe something close to the 124. We can see a little bit more definitive price action coming in at that level. Also the ADR high, but again, if we reach that level, I would want a short-term catalyst for the market to want to sell the pound against the dollar. But if you're just looking at it from a purely technical point of view, I think the 124 is possibly a area that I'll consider. And then not only the 120, I mean, the 120 is quite a ways down. I'll probably look to this as a first target area, because we can see a lot of support coming in at that 122.50. We've got that support back on the end of March. We've got it on the start of April, also back at the end of April, and now today's session as well. So I'll probably look at this as a level that you want to watch for a possible bounce, maybe take some profit or reduce some risk when you get there. You can also split the trade, so take off half here. If you think there's more room to the downside to 120, take off half at this level and let the rest run, and that's also an opportunity. But yeah, those are the type of levels that I'll probably look at for the pound. Oh yeah, no, there's no extra one, Jen. It's just it's this specific one for today. Yeah, Rich, the FOMO is definitely real, especially in this current market environment. A lot of FOMO going on right now. But you know what? It's for me. Let me put it to you this way: some of the worst mistakes that I've made in trading was FOMO trades. Sometimes I still do burn my fingers with FOMO trades, thinking that, no, man, I missed this, I'm just going to jump in. And I mean, 9 out of 10 times I normally regret it. So it is a learning curve. Sometimes it is something that I'll still do. But the best. I had a subscriber asking me a while back, what's the best way to learn not to make mistakes in trading? And the answer was losing money, right? So all of us, we're in this to make a profit. We're in this to make money. So the best teacher is really that P&L. Once you see the money starting to erode, that's usually for me the best way to stay disciplined is seeing that, okay, every single mistake is actually costing you real money. So there's a lot of incentive to try and get some of those disciplines in check. But yeah, it's not always easy. That's for sure. Okay, awesome. So we've gone through the Q&A and the chat. So let me just quickly pop over to the YouTube side and see if we've got a couple of questions there. Okay, great. A couple of questions here, guys. Just give me a second to see. Okay, good question here from Dion. You said that we expect the Aussie Kiwi to be supported in the short to medium term. Do we not factor in the possibility of a trade war between China and Australia, which is not out of the question? Definitely a risk factor. Dion, I don't know if you maybe entered the session a little bit later. But from a risk point of view, if we do see a further breakdown, that is definitely going to weigh a lot more on the Aussie compared to something like the Kiwi. So that is definitely a risk factor that we need to consider for this upside bias for the Aussie Kiwi. What is my thoughts on the USD Swiss? Okay, so looking at the USD Swiss as well as the USD Yen, not a lot of trading opportunities for these pairs right now. And the main reason for that is the way that the US dollar has been trading, right? So in a normal type of market environment, when we don't have a pandemic stress, when we don't have all of the uncertainty, the dollar sometimes trades as a safe haven, sometimes it doesn't. So it's easier to get a particular view on the USD Swiss and the USD Yen. With the current environment, however, the dollar has been trading as a safe haven, so appreciating when we have a strong risk of flows and depreciating when we have strong risk on flows. And for that reason, I'd say the safest bias to have, let's call it, if we can call it that, on the US dollar, Swiss franc, and USD Yen right now is a neutral or a sideways bias. Yes, there might be some ebbs and flows up and down in the short term that can create some tradable opportunities, but we always try to look at it from a probability point of view. So you want the highest probability trade ideas as opposed to something that feels good or looks good, for example. So there might be an opportunity on the Swiss franc versus the dollar, but as long as the dollar trades as a safe haven, it's more going to be a neutral sideways bias for me for those two. Yes, it might mean that you miss out on potential moves like this to the upside, but for missing out on that move without having a clear tradable catalyst or sentiment shift for it, you might miss out on this one, but there's going to be plenty of other trades that you can catch based on the same type of sentiments or same type of moves. So for me, those two are more a neutral bias right now, Jason, to be honest. Quick question from Lucas. Did the market already price in QE from the RBNZ if we got this choppy action all day? So looking at the QE, let's go to yesterday's daily risk event outlook report in the terminal. You can see there that, let's just quickly see. Where is that? There we go. So expectations are for the RBNZ to double their current 30 billion QE program purchases to QB 60 billion. So that was already priced into the markets. Also the on hold position today. So those two elements were definitely priced in already. Before we had the actual event taking place. So the main reaction didn't come from the fact that QE was doubled. That was expected. The main reaction came from the more dovish tone taken by the RBNZ with regards to the negative interest rate. So that was the big focus for the RBNZ today. Jason asking, what's the reason for US dollar weakness? We did touch that on the in the webinar, Jason. So maybe just when the session is done, you can just scroll back and just check out that answer. Do we ever combine timeframes? I mean, sometimes I do, depending on what I want to see. So, let's say let's take yesterday as an example, right? So I took a couple of shorts on the Aussie late session with the move lower in equities, and I obviously like these levels. So what I did before entering is I just quickly had a look at the wider time frame or the higher time frame, looking to see exactly how far we were from those highs. Getting an idea of the type of risk that I'm getting into for that scalp to the downside. But that's really the only type of combination, so to speak, is just getting a broader picture overall. But it's not a there's no particular strategy for doing it that way, so to speak. But the US dollar, if it's trading like a safe haven, shouldn't it be appreciating? Not really in today's session. We're not really seeing a lot of follow through from that negative risk flow we had yesterday. So we can see equity markets are up on the day. Looking at commodities, we can also see commodities are up on the day. Looking at yields, not moving down, but slight upside move. So overall, it is tilting to a slightly more positive risk tone right now, not really a negative one, which is probably the reason why we're seeing that downside in the dollar. The Squawk that we have, no, it's not free. It's actually part of the ForexSource terminal. The Squawk's just one part of the terminal. Of course, we have the live news feed, the written feed. We have the audio Squawk, but it's part of the normal subscription. If you want more info on that, just pop over to the website, forexsource.co. You should see some information there. You can also take a free trial if you want. I think they're running a free trial these days, which is also great. So you can just check out some of the features. It's best to try it out for yourself at no risk, of course. Robert's asking, do the big boys only use 4 hours and 1 hour charts? I mean, the thing about institutional traders, most of them, right, is most of them at least, is they don't even use candlestick charts. They only use line charts most of the time. It's just because they're not really focused on the very granular moves like retail traders are. So they some of them, I'm sure, uses candlestick charts, but the time frame is like you said, normally higher ones. But even if they do, switch between them, most of them actually just use line charts. There's not a lot of focus actually even on candlesticks. Okay, Paul, Powell is expected to reject the option of setting negative interest rates. If this happens, then stocks could rise while the dollar index dives. I would actually expect more upside from the dollar if Powell comes out and rejects it outright. So remember, the one of the reasons why we saw the lift in the dollar was actually some of the Fed members coming out actually pushing back against negative interest rates. Because remember, negative interest rates will drastically impact the yield attractiveness for the dollar. So from a theoretical expectation, if we are expecting him to push back based on what the other members already said. So I'm not really expecting a lot of reaction from negative rates. If he comes out and says it might be a possibility based on scenario, XYZ, for example, that can see some downside. But it has to do with the yield attractiveness. So as long as negative rate stays out of the equation, it should be actually more positive for the dollar from a theoretical point of view. We recently mentioned that the Fed's ETF purchases are already priced into the markets. However, when the Fed actually starts buying, won't that create additional flows and affect the price? Well, it does depend on what they buy, right? So what we said in that recent video was the expectation right now is for the Fed to buy certain specific ETFs like HYG, LQD. We also have Vanguard's corporate bond ETF. So if the Fed decides to buy anything not in the list, that should see some flows in terms of equity markets, but it might only affect the specific sectors involved with that specific company. So if it's only tech, it might only affect NASDAQ, just as an example. And of course, if they decide to not buy something that's already been priced into buy, like LQD, HYG, that can obviously see some downside repricing, and it should affect the overall flow of the market. But I mean, we need to watch out for the specifics. Not really seeing any major reactions from it as the move has already been largely priced in. Okay. Let me just take a quick another scan here, guys. Can we quickly go through the news that we saw and decided to short the Aussie last night? Okay, yeah. So let's quickly go to the terminal. Just quickly scroll down and tell you exactly what. We'll show you exactly what I jumped in on. So it was the Aussie yen, the Aussie US dollar. I think I also took a short on the Aussie CAD at that time. Come on, why can't we load? Just quickly go back. I'm not sure if the terminal is going to allow me to go back. Okay, it's not giving me an option, but basically, Janko, in a nutshell, it was two things. I mean, to some extent, it was the negative outlook from some of the Fed members, but that wasn't the main driver for me. It was the comment coming out from, I think it was U.S. health officials. I think it was what's that guy's name? Is it? I think it's 4C, or I'm not sure how to pronounce it actually, but he came out saying that there's a real problem in terms of a threat rather with the economy opening up in terms of a second infection breaking out in the US. That was one of the first ones, and we also had the comment coming out from the US Republicans actually voting to give Trump a possible a vote or the ability to add sanctions on China. So that was the main catalyst for wanting to jump in on that. Okay, guys, it looks like we've gone through most of the questions. Let me just quickly pop over to. We have a question here from Raza saying that he took a short on the Euro Aussie at 168. Let's quickly open up the Euro Aussie. $168. Okay. Looking for an area to bank some pips. Raza, from an intraday perspective, I'll probably look for very close to where you're getting at now. We can see this overall support area, also close to that ADR low of the day. It is a little bit choppy in this area, but we can see some support and resistance evidence coming in over here. Let's see what we're looking at in terms of psychological levels. We do have the 167. We're just breaking through that. The 166.50 is a little bit lower. So if you're in from 168, I'll probably consider where we are right now as a possible opportunity. Yeah, anything in this overall area, I think, is an opportunity to look for a possible place to bank some pips. Okay, awesome, Raza. No worries at all. Okay, so let me just pop over once more to the YouTube questions and see if there's any new ones. You didn't answer my question. Okay, let me just move up. I'm assuming it's about the Fed ETFs. When the Fed actually starts buying, won't that create additional flows and affect the price? I mean, there's nothing really more for me to say about that, to be honest. Yes, it can affect it if they decide to buy something else that's priced in to be bought. If they decide to buy something that's not priced in, that can affect it. The actual buying itself has been priced in largely. So no, I'm not really expecting any additional flows to really affect the price. If there's anything more specific that you want us to answer on that, of course, let us know. Okay, we've got a quick question here from Mark. Looking at the Kiwi dollar now in the possible sell zone, but sentiment and the dollar index isn't giving any confidence. So we are seeing equity markets moving higher in this session. Looking at yields, we can also see them starting to edge up slightly across the board as well. Commodities also edging higher across the board. So looking at the Kiwi versus the US dollar, it does take a lot of the conviction for that downside bias out of the way right now, Mark. What I'll possibly do for the Kiwi is I'll take a more neutral bias and stance on the Kiwi dollar versus the US dollar right now. Wait for that speech from Powell. I think that should give us a clearer direction for the dollar. For now, as long as equity markets move up, as long as yields are moving up, as long as commodities are moving up, it is pointing to a more positive risk tone. And that should lead to more weakness for the dollar index. So yeah, I agree with you. I won't be looking for a potential short on that just yet. I'll probably wait for Powell's speech and see how that affects the overall risk tone in the market. Okay, awesome. Always a pleasure there, Mark. Okay, guys, looks like we've gone through the Q&A. Looks like we've gone through the chat. Looking at the YouTube questions, it looks like one viewer is typing a question. I obviously don't want to let the rest of the crowd wait. So if there's no other questions, guys, I'm going to let you guys go for today. Main focus points on what we need to focus on, as we said, the overall risk tone right now. As long as that stays positive, it should lead to more support for the high beta commodity linked currencies like the Aussie and the CAD, even the Kiwi, despite that RBNZ decision, and also lead to more downside for the US dollar, the Japanese yen, and the Swiss franc as safe havens. Watch out for that speech coming up from Fed Chair Powell. That can be a big market mover. Not expecting a lot, to be honest, but if we do see anything surprising coming out of that, that can obviously affect the overall risk tone and can provide an opportunity to maybe sell some of these high betas at much better levels, especially against the dollar. So definitely something we want to watch out for. Also looking at the upcoming events, make sure to catch the inventory, the oil inventory coming up, as well as the Aussie jobs report tomorrow. That can also create some tradable opportunities. So that is everything from my side. Okay, wait, we have that follow-up question. The Fed is expected to buy ETF1, market buys ETF1 in anticipation of this. The price rises. Fed then buys ETF next week. Price rises again substantially due to their money. Well, again, it's about expectations, right? So if you look at something like, let's look at LQD as an example. Let's take HYG. So the move to the upside, the real trade was back in the middle of March, right? So the real trade was actually buying it in anticipation of junk bonds, for example, in HYG's case, to be bought. So that was the real trade. Right now, the actual purchases, how much is being purchased, we know what the amounts would be. So, I mean, if they decide to not buy HYG, for example, that can see some potential downside. If they decide to buy more HYG compared to LQD, for example, that might see some inflows as well, but not really expecting any major tradable opportunities from that, just from the offset. As most of the upside has been priced in already. So yes, there can be some short-term flows, like we said, if something is bought that's not already priced in to be bought, that can affect it. But the actual purchases itself, it's like QE, right? So the Fed announces that they are going to start QE in a week's time. That drives the market's anticipation for QE. When the Fed actually starts to buy bonds, it doesn't really have that same impact in the market. What will have an impact is if they increase the amount they plan to buy or decrease the amount they plan to buy, or as we said, buy something completely different that's already priced in to buy. So I think that's going to be the biggest trading opportunity. Buying or selling it on the basis of the actual, buying and selling, I just don't really see a big opportunity there right now. Okay, guys, thank you so much for joining us for today's session. Also for the guys that joined us from YouTube, thanks for the session. Forex Orb subscribers, make sure to catch the video commentary for today. Obviously, we'll make sure to cover any type of tradable sentiment shifts coming out from that Powell speech. Any other tradable sentiment shifts we notice will pop into the terminal. Any questions, as always, please let us know. For my side, I hope you guys have a great trading session for the rest of the day. Today is Wednesday, so I'm only going to catch you guys again on Monday. Tomorrow you'll have Giles in the room, and on Friday you'll have Dan. So I hope you guys have a great trading session for the rest of the day, the week. I'll catch you on Monday. Good luck with the trading. Any questions, just let us know. Thanks, guys. Take care.